The real GDP story is not that it was negative. In fact, it was positive, but the bad accounting is hiding the real issue going on, which is the AI investment that is powering a true GDP growth story in the US economy right now.
Maybe tariffs are not a tax on the consumer. We might actually find out that this whole entire tariff narrative is actually a gift to anybody who earns $150,000 or less.
There is a student loan, slow motion, and maybe not as slow as you think, apocalypse occurring because people just aren't paying their loans back like they should be.
DOGE is just getting warmed up, and the story on DOGE is not actually cost cuts. It is AI, and Wired is the only one getting it right. Let's talk about that.
Wall Street's wrong again. This week we'll pick on HSBC. Twilio, a company that has a lot of interesting things going on when you look at it the way the biggest investors in the world do.
And lastly, we've got Skechers. And let's talk about why 3G might have snatched a really smart buy here, buying Skechers under investors' nose. We've got that and everything else today on the Altimetry Authority. Let's talk earnings and favorite pastimes.
So let me just say, earnings
Wall Street. That's 2.5x
because their compensation goes up.
Wall Street's wrong again. So while everybody's focused on this headline number of minus 0.3% of GDP, we're about to explain to you the reality, which is what you really should be focusing on, is what was going on inside investment underneath it. So let's actually get into the details, because that minus 0.3% in and of itself, everybody, gross mischaracterization of what was going on with economic activity. So that minus 0.3%, there's two big numbers in that GDP number that are really, really important that people struggle to wrap their mind around. The first is net imports. So net imports are a technical drag on the economy because you're basically sending money outside the US. Well, normally net exports, net imports are like a 0.15, 0.16% drag over the last 3 years on GDP. This quarter, Q1, I should say, before the Trump tariffs came into play, everybody scrambled to pull forward all of their imports. So net imports was a negative 4.8 pull on GDP. It made GDP 4.8% lower than it would have been otherwise, effectively, right? And then the other really important thing is inventories. If you're pulling a whole bunch of imports forward because of the fact that you are trying to avoid having them hit by tariffs, whatever the tariffs were going to be in April, May, June, right, as we found out on April 2nd, you're going to have to store that somewhere. That's a build in inventories. Inventories was an increase in GDP because effectively when you build those inventories, we say, hey, that was economic activity of 2.25%. So you combine those two things together, and what you see is if you remove that noise, the volatility because of the tariffs, and you look at it, what you see for a real number, and this is what this blue bar is here, that blue bar is what the real number of GDP should have been if you basically remove the volatility that's happening right here. It really was closer to 2% was what actually GDP was. And this is the whole entire thing is, first off, just on first blush, the market was totally missing if you're following that headline of GDP, thinking that, oh my goodness, Trump was already destroying the economy in Q1 as people were panicking. No. People were just reacting ahead of time. And if we remove that noise, Joel, what we see is something very, very different, which is economic activity was not that bad.
Now, first off, I mean, GDP is a bad metric for understanding the health of an economy anyway. It is, right? And part of the reasons is because these nuances, because it includes government spending. So if a country like Germany did a couple years ago, or others, or China wants to make it look like their economy is better than it is, just pump up government spending and take out massive amounts of debt, right? Thereby also rooting your currency, which you won't see in a GDP number. None of those things are GDP numbers other than, government spent more, so GDP went up. So there's so many big reasons, but this is another reason we rail on GDP as being a bad indicator of the economy. There's other better indicators like, total corporate profits, total taxable income, people making more money, wages, discretionary income, a lot of other stuff that people say, well, GDP kind of measures that. No, it doesn't. If you're going to measure those things, then measure those things. Don't say GDP is a proxy for that, right? And so there's a lot of things that are going on that are very healthy for the U.S. economy. Now, that said, if we even do look at GDP and we take out that nuance of that specific imports versus inventory, we really had a growth in the U.S. economy of about 2%, which is not bad which is not bad for a country of this size and what it's doing. And with the amount of cuts that came out of the government and are coming out of the government, right, in this year, you'd say, all right, there's also an offset, but we're not even talking about that. We're simply saying make one adjustment only, the import and inventory adjustment, and you're already at a 2% GDP, not a negative GDP.
And if you remember that just next quarter, everybody, it's going to be, what we're going to probably see is GDP is going to go through the roof because of the fact that for most of this quarter, we weren't importing anything. And so imports went from being basically normally neutral to a slight drag to they're going to be a massive benefit. And everybody's going to be like, oh my goodness, look at what Trump did. It's like, no, look at the real data. And so to Joel's point, right, to your point, Joel, let's look at some indicators that get closer and closer to reality here. And so what this is another popular indicator, which is real final sales of to private domestic purchasers. Basically what this metric is if you remove all of the noise for inventories, if you remove all the noise for imports and exports, if you remove all the noise from the volatility that happens with government spending, and we just look at what's going on in the economy, how's the economy doing? And what you can see here is, holy cow, look at how good the U.S. economy is doing. The U.S. economy has been basically growing at 3%, lock in, lock out, when you ignore the noisy parts of it and you just focus on what are consumers and corporations doing to make economic decisions. We've been 3% a quarter almost every single quarter. And by the way, this quarter, we will once again 3% this quarter. And there's a reason why things had looked so well this quarter, even though, as we're going to talk about a little later, the consumer is not doing great, but there's a reason. And also, right, everything that's going on for the government with DOGE and the question about imports and exports, the reason why the economy is doing so well is actually this. This chart shows you right here, this is what the basically impact to GDP growth from corporate investment. And specifically, this is fixed investment in IT equipment. And so what this is, you can see it bounces around. This is right now the benefit to GDP from investment in IT equipment. And Joel, what do you think is a reason why people might be investing in IT equipment right now? I can't think of a reason why.
The politics and all these headlines and the mass financial media and the mainstream media, which are all tainted, right, and just want to talk about sensationalism, are burying the real headline. The real headline is that AI is doing a transformation on U.S. productivity and the U.S. economy, a positive transformation, a very positive one, which is bigger than the PC revolution in the 90s, is bigger than the internet in terms of increases in absolute productivity that people and companies are having and the benefit to their lives that is getting buried. And when people realize that's how much AI, obviously IT equipment investment is heavily going to AI, is making a difference for every company and making them more productive and allowing for, frankly, having more goods and services available to more people at a much cheaper level. That's what it's saying, right? Means also its impact on inflation ultimately, on helping to reduce it, and all the good things that AI can do, right? Not to mention this nonsense about AI is stealing people's jobs. No, AI with a person is going to steal the job of a person who doesn't have AI. But no one is saying AI is just going to take over. I mean, yes, there are some people saying that, but the truth is AI with a person, right, with a worker, makes them so much more productive. And that's what we're benefiting from. That's the real headline of what's going on and why the U.S. growth is doing so well. And this nonsense about, the overly politicized media, financial media, that's just missing the point completely.
Exactly. And if you look at this, just for context, everybody, look back at the late 1990s, which you've heard us talk about a lot in terms of how the dot-com boom, and that's the best proxy, but even that understates how big the AI boom is going to be. We had literally 3 to 4 years of, call it 80 basis point benefit of IT investment powering the U.S. economy and basically adding 80 bips to U.S. investment. If you look over the whole entire of this period, it's probably on average about 20 to 30 basis points, right, in terms of what it means from a benefit on GDP. But for that 4-year period or so, you saw an 80 basis point benefit. Right now, we're at the highest amount benefit on GDP from IT investment because we are seeing an AI investment boom. And that AI investment boom, whatever is going on with tariffs, is going to keep on happening because of the rush we have for us to get there, for everybody to get there and adopt all those things. And that everybody isn't changing. So don't get distracted by everything that's happening in the headlines in the news right now, everything that's happening for tariffs, everything that's happening for GDP growth and everything else. keep your eye on the idea of what's really going on for AI investment. But Joel,
Look, if
we're
you
talking
are properly
yeah,
invested in if you are properly invested in U.S. equities the way you should have been, and stayed invested and not get caught up in all the roller coaster ride that we've been seeing from the headlines, then you're doing the right thing. If you're under invested in equities based on something like our timetable model, right, which you can get on our website, our Wealth Foundations, our timetable model, and if you're under invested in equities, we're still saying you should invest into U.S. equities over the next 8 months. This is not the time to get spooked and scared by these GDP nonsense headlines or whatever, when you understand how strong the U.S. economy is, not just, by the way, from AI, but across the board, let alone when you include AI.
And so, Joel, right? So we're talking about how AI is a huge benefit for the economy, and there's a lot of noise out there. But let's talk about something else that we often, want to focus on in terms of a big thing that powers the economy. Let's actually talk about taxes. And let's talk about taxes, maybe, Joel, in the context of the current tariff noise and everything that's going on. You got a different perspective this show in terms of what we talked about before between tariffs and taxes. But how they fit together, let's talk about it.
Yeah, you see the 10% number that people say, why is there a 10% tariff number being applied to all these countries and being the baseline and whatever else? And when you look at it, it actually makes a lot of sense, right? And it's very consistent with the other economic policies they're talking about. And why is that? Well, let's say we have a 10% tariff, right? The 10% tariff on $4.5 trillion of imported goods to the U.S., right? I'm using a number, it was last year 4 trillion, maybe theirs is 5 trillion, maybe it comes down, but let's say it's 4.5 trillion, and maybe as much as 700 billion or so, right, is avoided, right, under Mexico and Canada, whatever trading, right, something around that. So let's just get to something like $4 trillion is a round number that gets a full 10% tariff. It's actually slightly higher, I'm being conservative, right? It's also slightly higher than 10% because some countries like China are definitely going to get more than 10% when all is said and done, when all the dust settles. But it'll be something a little more than 10% and a little more than 4 trillion. But that number conservatively is a $400 billion, right? $400 billion on the 10% tariffs in federal revenue. What number does that allow you to avoid in taxation? So if the U.S. collects $400 billion, right, conservatively, in tariffs, it means you could give a tax cut to everyone making 150 grand or less in adjusted gross income, meaning that number that goes in your tax return that says, here's how much you're going to have to pay in tax. So if everyone makes 150,
right,
yes.
Well, Joe, I mean, right, because that is something that the administration has talked about. Whether or not it'll ever actually happen, that is something that the administration has floated, right?
They've specifically said 150 grand. And a magic is that at 150 grand, the amount of total federal tax that is collected from people that make an adjusted gross income on the tax return of 150 grand or less is $400 billion. And so when you say, oh, so these kind of match up, 10% tariffs conservatively is going to get you $400 billion in revenue, federal revenue, and you're going to be able to cut taxes of $400 billion. Mm-hmm. You come out with net, no new deficit, no increase in deficit. In fact, you actually have some cushion there because the tax number is a good one. It is $400 billion. The amount that we'll collect on tax on tariff revenue is probably higher than $400 billion, right? And so you really could say for 125 million taxpayers, that's individual or married, filing jointly, 125 million taxpayers pay zero federal income tax, and it can be easily afforded by the U.S. government with no increase in the deficits, no increase in the national debt, by simply making sure you put in a 10% tariff across the board. Now, what some people say is, but wait a second, if you're just giving people a 10% tariff break, right? I mean, you're giving them a 10% tariff, but you're giving a 10% a tax cut that's the same amount. Won't people save that money and then spend it? No, that's not the case. It's not like a sales tax of 10%. Sales tax at 10%, you'd argue, well, now people are going to save on their taxes, we're going to spend it. But the fact is, like in 2018, 2019, where we have real examples of what happens, the producers, the people selling imports into the U.S., will actually eat some of that 10% tariff, right? And so when you talk about China and what they did, so back in 2018, 2019, the exporters selling in the U.S. took a cut of at least 20 or 30%, meaning if they're selling something that's worth $100, they didn't then take the full brunt of the tariff. They actually said, no, we're going to reduce our cost to the U.S. from 100 down to 95 or 93 or something. They'll eat it in their profits so that they don't lose market share. That also happened with apparel. With apparel, by the way, the pass-through of the tariff, when people say tariffs are the same as taxes. Now, on apparel coming from other countries where the margins are often much higher, meaning they have more profit to be comfortably saying, all right, let me reduce my profit to make up for this so I don't lose my market share. Maybe it was only a 50% pass-through. A 50% pass-through. So it is not the U.S. consumer that pays for 100% of tariffs. The U.S. consumer pays for some of the tariffs in things going up, but not all of it. So then people say, all right, let's say the government is getting tariff revenue of $400 billion, and then they're saving taxpayers $400 billion in income taxes. Isn't it a wash anyway? Meaning, don't taxpayers end up just spending that money? That's not the case. Right? The case is, well, taxpayers may save $400 billion in actual federal taxes. They won't spend all of that in additional prices of $400 billion. And the reason is we've seen in past history that the producers of products that are being imported to the U.S. will eat some of their profits to maintain market share. And so in things like electronics and other consumer stuff coming from China, the Chinese companies and around the world, companies will eat as much as 30% of the tariff. So that doesn't all pass through to consumers paying more. On things like
Joel,
apparel,
really quick.
you may only...
Wait.
Yes, sir.
Before you keep on going, it makes sense because there's this idea, right? I've said this, right? The idea that tariffs, if you think about them, are this regressive tax on everybody because, right, consumption is taxed, not income. And so as opposed to taxing the highest the most, what you're basically doing with this, if you combine the two of them, is you're solving it. But there's another important thing. It feels like, to your point, the market has had this mental model where they are reflecting that some of these companies are going to take some of this tariffs, right? Because a lot of the market for these consumer companies, the market's pricing in ROAs to come down, but then the market is also assuming that consumers are going to take all the hit. And your point is it's somewhere in between, right? As we keep on going through some of the examples.
The companies that are selling the things imported in the U.S. will take a price cut on their costs to make the tariff not as troubling for the U.S. consumer, meaning because they don't want to lose market share. They want to still be competitive with local, products or whatever else that don't have the tariffs, or products coming from Mexico and Canada that for whatever reason may not have tariffs, given the Canada-Mexico trade deal is still in place, the USMCA. So when you think of that, consumer prices, the pass-through on things like electronics and other things from China, for instance, we've seen it. These are real examples from 2018, 2019. Right, those goods you will see maybe a 70% pass-through of the tariffs. On clothing and apparel, you may not even see even 50% pass-through on those items. On other kinds of things, exporters might absorb as much as 30 to 40% of the tariffs. So in general, you're not having $400 billion in federal tariffs result in $400 billion of increased prices. It's something less, $300 billion, maybe $250 even, maybe even $200 billion, depending on how much companies can absorb some of it. It does not all get borne the way like a sales tax would if we just said, let's exchange sales taxes for income taxes. It's not that. The producers actually absorb a decent chunk of it. And because of it, right, you then have this wonderful, on 125 million taxpayers, tax cut, right, that then still gives them the power. Because at the end of the day, and this is Art Laffer and the Laffer curve, when you tax production, you create less production. When you tax consumption, you create less consumption. Well, which would you rather have, right? So if a taxpayer says, okay, I have more money, but I can still choose whether to spend it, versus I get hit on my taxes, I have no choice, it's gone, it goes to the federal government, and now the federal government's going to do whatever gross inefficient spending it will on it, versus the taxpayer saying, I'm going to decide whether I'm not going to buy that more expensive thing or not because I need it or not. And so, on this issue, I think the synergy between how it happens to be around $400 billion of tax revenue lost by giving everybody that makes 150 grand or less a tax cut, and that it just is a fantastic thing, and I think that's what we're looking forward to.
No, it makes sense. And I mean, you look at it, and the great thing is it actually ends up potentially being, if we get the $150,000 and below tax cut, it begins to be a benefit for consumers because everybody, there's something else that is quickly coming down the gauntlet for consumers, which is going to be less favorable, and that is the slow-moving student loan apocalypse that we see coming right now, which is a reason that, quite frankly, the consumer needs the government to do it a favor in some way, shape, or form. So going back, for those of you who are not aware of what's going on in the headlines here, so student loan forbearance happened in the middle of COVID, where everybody said, hey, you don't have to pay your student loans anymore because of economic hardship and COVID. And then basically a year and a half ago or so, we restarted forbearance. We stopped forbearance and said, hey, you got to start paying again. But here's the thing. We won't actually punish you if you don't pay. For now, we won't report it on your credit score or anything else. And so you looked in January 2024 when the first window of, basically forbearance ending, but you didn't have to pay. And you looked at how student loan payers were doing. 29% of student loan payers were past due in January 2024. And it gets worse because what happened was this idea of when you tell people that a debt isn't real, people start building their budgets like the debt isn't real. And so if you look, this chart here shows you U.S. Treasury deposits from educational department programs, right? So this is the idea of how much money is the U.S. Treasury taking in from people repaying their student loans. Unsurprisingly, back in normal times before COVID, the trudge of payments higher kept on going on because student loan debt amounts were growing and people were keeping current with their student loans. And so you saw this steady rise in
money.
Right, exactly. And so they were able to
money, so they could make their payments. Yeah.
Exactly. So we got to the point where around $7 billion a month basically was coming into student loan repayments. And then what happened was COVID. Right, COVID happened, and basically the government said, hey, look, as one of the many ways that we're trying to not destroy the economy, we're going to pause everybody's student loans, right? We're going to go into forbearance, which basically says we're not going to punish you for not paying. We're not worried about you paying or not. And so, of course, not surprisingly, student loan debt payments dropped dramatically. Some people kept on paying their debts because they wanted to pay off their student loan debts, but a lot of people said, oh, I don't have to pay my debt? Well, then I'm not going to pay my debt. And then what happened was we got the on-ramp. Like I mentioned, in late 2023, September 2023, the U.S. government said, hey, we're stopping forbearance. You have to start paying your loans again. But for the next year or so, we're not actually going to punish you if you don't start paying, but interest and everything starts kicking off. Well, initially, right, because people do want to pay things when they have to pay things. Initially, you saw the actual amount that people were paying for their student loans pop back up, basically like the forbearance never happened, right? Jump back up to 2019 levels. But then look at what started to happen. People who had built their budgets around not having to pay student loans really started to struggle to pay student loans, and so people just stopped paying them, right? We already saw basically a third of people who pay repayments drop off. And what's really interesting was this didn't show up in the student loan, the frequency in terms of how on time you were, in terms of what percentage of student loan debt was delinquent, how fast people paid, because nobody was reporting it. This chart we're showing you here, this is for the U.S. Fed, the New York Fed. They track the how late people are, how delinquent people are in different kinds of consumer debt, from credit card debt and auto loans to mortgages and student loans. Student loans is this orange line here. You can see the student loan line is still really, really low here. Why? Because nobody was reporting what was going on for student loans. But if you notice, something really interesting happens. Right here in September 2023, every single other kind of loan out there started to see a rise in delinquencies. I wonder why. Perhaps because people started to try to pay their student loans, and even though student loan delinquency rates weren't showing up, everything else was starting to stress because the consumer was stressed, Joel. And now, Joel, finally, and this is the important news, everybody, as of April and May, basically all of the credit rating agencies are gonna actually start showing how delinquent people are. And the numbers are scary, Joel. Right? I mean, literally, we're talking about an idea of the highest delinquency rates we saw was 15 to 16. Now, Joel, we're talking about 20% is what I've seen throw around somewhere in terms of student loan delinquency rates that we're going to start to show. And the point of this, everybody, is The consumer was already under stress, as we highlighted with those rising, creeping rates in terms of delinquency rates. And now you've got student loans stacked on top of it and, right, some level, Joel, of tariffs. And Joel, if we look at what's going on for consumer discretionary stocks, when we look at it on a uniform accounting basis, it shows that was already a tax on consumer discretionary stocks. Fair, before we even get into where things could go.
Yeah, so a few things. Pre-pandemic, delinquencies are already something like 12%, right? And then the idea that they're not at least 12% now, when we're getting close to where payments are required on student loans, because they are, you have to start making payments, right, about a year ago or more, that the payments being collected are getting to as low as they were during the COVID freeze. So there's no way it's a 12% delinquency rate, which is what it was pre-pandemic, when you're getting collections that are as low as during the COVID freeze. So if we have good numbers, it's probably something like 20% delinquencies. It's really, really bad. And where is it going to hit? That's going to hit places like consumer discretionary stocks and consumer discretionary companies, because when they do have to make those payments, or when they start getting their credit hit because they can't get credit cards as easily, or they have to pay much higher rates because they've got bad credit because they decided, well, I didn't have to pay back then, why don't I have to pay now? Which happens, right? This is going to cause some ripple effects, and we're being very careful to stay away from stocks that are dependent on people, right, who will have student loan debt and other debts. We are concerned about the consumer in those spaces.
And so everybody, what we're showing you here, this is for consumer discretionary companies in the United States. We aggregate them using uniform accounting, look at their profitability. If you look back from the early 2010s, when everyone was recovering from the Great Recession still, return on assets averaged around 10%. Now, once we got past that, right, once you get to the Trump tax cuts, once you get to a stronger economy and everything else, return on asset levels for consumer discretionary companies jumped up to 12, 13%. Well, already in 2024, because of the pressure the consumer was under, because they were already starting to try to pay for their student loans, other debts were, basically creeping up. We already saw return on assets.
Higher interest rates,
right? Basically putting a pressure on their ability to afford anything. We already saw return on assets drop by 200 basis points. In 2025, return on assets for these companies is forecasted to drop to 10% because of all the issues we're talking about here. The consumer is under pressure, and U.S. consumer discretionary companies are feeling it, right? This is going to be some of the tariffs, whatever they end up. Joel, to your point, they're going to have to take some price on that. So we're going to see lower returns, lower demand for consumers and everything else. But here's the thing, everybody. The reason why we've steered clear of U.S. consumer discretionary stocks in basically anywhere that we recommend, even, Joel, with the idea of the $150,000 and below, if we actually saw a tax cut to zero for them, is because the market is not pricing in these headwinds for U.S. consumer discretionary stocks. This last bar here, this is when we aggregate the market cap for all these companies, what the market is pricing them to do. And the market's pricing all-time highs in terms of return on assets for consumer discretionary names still. And so look, well, to the point that we were talking about before in terms of what's going on for how tariffs and taxes might help somewhere for the consumer for all this, there's a whole lot of other issues for the consumer. So don't think that anything we're talking about here says you should be buying the U.S. consumer and U.S. consumer exposed companies. Those companies are still going to be under pressure for a while, Joel.
I think the student loans are going to make that happen. Yeah. It's going to be a big part of it. Along with the rest of the consumer debt, we're seeing delinquencies across the board. Be careful of companies that are dependent on that discretionary money, because it may not be there with particularly those groups of U.S. consumers.
Right. But as we highlighted, there's another part of the world that is reason for you to be bullish, which is why we continue to be bullish on the U.S. stock market overall, and that is AI companies. And there's one part of the U.S. economy that AI is definitely helping that people are missing the real narrative on, and it's what DOGE is doing as it's just really now, even with Elon stepping away, just getting warmed up, which is what's going on with DOGE and AI. Joel, I think we both agree there's really only one mainstream news agency that's actually getting the narrative right on DOGE, that DOGE is AI, and it's Wired, right? Wired is the only one, right? Exactly. Wired is the only one, right? To your point, Joel, tech focused, that they're understanding, hey, the real narrative with DOGE isn't cost cuts, it's about what they're trying to do with AI. Now, everybody, Wired, if you go and read their stuff, is very fear heavy with this. It's very Big Brother 1984 in terms of how they explain what AI is doing in the US government. But what they are getting right is AI and unlocking AI to empower the entire US government and turbocharge the US economy is what's really going on with Doge. And while they can fearmonger all they want, the reality is when you step back and you look at it, this isn't something to be afraid of, it's something to be excited, right? I mean, this idea of, basically Doge following the Elon algorithm and the Elon playbook of question everything, which was the first stage of everything that went on, then delete anything you can, right? Getting rid of parts of business that he does, parts of the government operation that he didn't think that we needed, then optimize, accelerate timeline, and automate. This was all about unlocking AI. And I thought, Joe, I thought that the funniest one was the not funny, but just in terms of highlighting fear mongering versus getting the actual narrative right, was when we talked about, for anybody who saw this, there was this idea of the IRS hackathon and how everybody was terrified that we were trying to use AI in the IRS to identify fraud and to do all this stuff. Literally, we talk about hiring, what was it, Joel, 80,000 IRS agents? Was that what we hired during Biden's presidency? Something like that?
Yes. During
Right?
President Jill Biden's administration? Yes, I think
Yes,
you're right.
yes. During President Biden's administration. I'm not going to respond to the half of that you said. But so, right, and we said, oh, hey, this is good because that's going to improve our tax take. We're going to make sure to catch fraudsters. But it's like, oh, wait, using Doge agents, right? Agents, AI agents, Doge agents to track that down and doing a hackathon to build that. Whoa. That's an infringement on consumer data. It's like either you want improved tax take in the US government or you don't. But how we get to it, why would we not want to use AI to do it to make more efficient and actually not have biases like you're going to have with the government? And so look, everybody, this is the whole entire point here is when you look at what's going on with Doge, it is unlocking $1 trillion opportunity here because we've already seen Fed AI adoption grow by 1,200% in the last few months because of what's going on, I'd say the last year and change, because of what's going on with Doge and otherwise. And we've already seen a ton of companies have huge rises in terms of their stock, from the Palantirs of the world to the Big Bear AIs, airships, all up 100, 200, 600%. But if you focus on Doge because you're afraid of the cost cuts and everything, you're missing that AI narrative. And the fact that what Doge is doing right now is turbocharging the whole entire narrative for the US government adopting AI. And right, we can actually finally say now that if you were not a fan of it because of Elon's basically stepped away, which, by the way, was always part of the playbook. And the real thing we're watching now is we're watching David Sachs and we're watching what's going to happen by July 22nd, because that's when he has to release his AI plan. And when he does, it's going to mean huge things for a set of companies that are at the center of the AI ecosystem that we're so excited about. In fact, we just wanted to highlight this because we just released a presentation on this that if you click on the link below, you can actually learn more about, where we highlight some of the companies that we think are going to be big winners and why we think when you talk about that idea of the AI boom being the real narrative here, as opposed to tariffs or anything else, or even the consumer, it's at the heart of it. So everybody just keep a watch on that. Something really excited. And please click the link below if you want to hear more about that. But so, Joel, now that I'm off my soapbox on Doge, let's talk about another AI company that people are misunderstanding. Let's talk about why Wall Street's wrong again on Twilio. I think that you have some strong opinions on whether or not HSBC really understands what the words reduce and hold and buy are, and if Wall Street has hold us.
Aside from all the cool things that Twilio does and how it's necessary for voice and messaging and all kinds of things behind the scenes that people are using every day, and may not realize that they're using things that are powered by Twilio every day. But the Wall Street aspect of this, right? First off, upgraded to hold from reduce at HSBC. This absolute nonsense. And everyone just on CNBC and Bloomberg or whatever else nod their heads like, oh, yeah. And it's like, okay, what did reduce mean? Did reduce mean reduce completely? Did it mean completely empty? And when you go from reduce to hold, does that mean, okay, we told you to sell your stock in Twilio, and now hold means just hold the stock that we told you to already sell? Right? This kind of nonsense, right? The idea of the investment banks to this day don't realize that words mean things, and they trash the English language using these words like hold. And you're like, hold and do what? Like hold the stock or hold off from doing anything? How is a hold different from a reduce? If you're reducing, which means get rid of the stock, but now hold and do nothing, or does it mean hold the stock that you didn't sell when we said reduce, but we never told you how much to reduce by? It's just a bunch of nonsense that Wall Street still pushes out. It's meaningless. Hold, reduce, buy, sell. It's just meaningless names that Wall Street gives because they don't at any point want to really anger corporate management. In this case, their HSBC probably wants a piece of Twilio's banking business, so they've moved from reduce, which I think sounds bad, to a hold. And they got away with the reduce, and this is important. The reason they got away with the reduce and could say to management, hey, it's not our fault we said reduce, is because Twilio was reporting negative GAAP earnings. So what banks normally do, what Wall Street banks do, is they'll say, you know what, hey, we have to say someone's a reduce is less than a hold, whatever the heck that means, is a sell, right? We have to say it somehow. And the way we say it is look for something that we can point to the management and go, hey, management, it's not our fault. I mean, you got negative earnings, you got negative return on assets based on all the major databases, so we kind of have to say reduce. But if you can get back to just break even, we'll bring you up to a hold. And hopefully management won't get angry and just say, yeah, we understand, whatever. But that's all based on GAAP earnings. That misses the entire true picture of this company. When you look at uniform earnings for what's been going on with Twilio, right, not only is this company generating a fantastic return on assets for the last several years, and in 2024, getting to a 20% return on assets. Now, remember, GAAP accounting punishes new growth, it punishes innovation, it punishes research and development expense. It does. It punishes in a way that does not make sense. It violates the matching principle of accounting, where you're supposed to match expenses against the revenues. And so when you take care of all that, and you look at what the greatest investors of the world are seeing, and by that I mean 200 plus of the 300 biggest money managers in the world who use our content, who use our database, you're looking at a return on assets that's really closer to 20%. So HSBC is missing the point on this completely, right? Completely. Now, on top of that, what's embedded now with the current stock price?
Right. And so which is really quick, Joel, and just for everybody for perspective here, right? When you look at Twilio, the reason why, to Joel's point, HSBC upgraded Twilio is because they said Twilio is had a solid Q1, has really strong revenue growth, and also they raised their 2025 guidance. So they're saying, hey, this company is going so well, we're going to move it to a hold, because they're missing the picture in terms of how profitable this company is and what's really going on with AI. Because what's really important here for AI, Joel, before we get into what the market's pricing in, is Twilio is unlocking AI to empower anybody who uses its customer service platform, right? So Twilio, they are, for so many big companies, the backbone in terms of how you engage with customers through email, how you engage with customers on phone for when they call your customer service company group or anything else. And what Twilio has done, it's been the platform for people to do that forever. But now it's unlocking AI to help people better target who they're going to reach out to for their customers, better talk to their customers, to get more revenue out of their customers and to hold on to that revenue, and also just to even empower and using AI. So all that stuff means people are running to Twilio to get their products, which is why return on assets, Joel, has been taking off. And now, Joel, let's talk about how you couldn't possibly, if you knew what was really going on for the company, think that it's a hold in the background of all that narrative.
Yeah, so what this is showing is to get to today's stock price, you need to take these fantastic returns that they've been posting for real, meaning under uniform accounting, true earning power, that are expected to go up in 25, expected to continue to go up in 26, and that for some reason they're just going to collapse back down. That's what's currently priced in, is this collapse back down. That's the market implied at current prices. So what that means is if the company just held the ROA of 25% that they're looking to get next year, heck, even if they just held what they're getting in 2025 so far, it just held at that level, this stock would have to go up by, I don't know, several billions in market cap, 20, 30, 40, 50, maybe even 100% upside based on what the market's pricing in, partly because of Wall Street and its bad numbers, and partly because a lot of people using GAAP accounting, the as-reported numbers, think the company is barely breaking even when, in fact, this company is truly making money hand over fist.
Right, exactly. And this is the thing is when we see this, what we can see is this company is crazy profitable and it's forecasted to get more. And this is, by the way, everybody, well, just to be so you all know, this is a company we recommend to our subscribers because this is such a no-brainer to us. We're like, wow, Wall Street totally is missing this, but this company has such tremendous upside. If it just keeps on riding the AI wave it's already riding, let alone if it continues to unlock more things, it could have a Shopify-like run. It could have a run like some of these big AI names that the market's totally missing because of those bad as-reported data points. So Joel, that talks about a company that when we see the revenue revival, it's going to do very, very well. Now let's talk about a company that maybe investors aren't going to bet on anymore, but this is actually something Joel and I like to talk inside baseball sometimes, meaning, let's talk about what everybody thinks about from what already happened. And so let's talk about Skechers. So for those of you who don't know, Skechers recently was not acquired, but is going to be acquired. 3G offered $63 a share, basically $10 billion buyout to buy tariff hit Skechers. And, the reason why, right, Skechers got beat up, quite frankly, destroyed by the tariff news that happened in early 2025 when Trump came into office and basically started talking about how hard it was going to be. So go ahead, Joel.
Rightly so. I mean, anyone that wears Skechers, the great, majority of Skechers sneakers and products are made in China, right? And you're facing a 145% tariff. They do not have the kind of profit margins to just eat that completely. They do have some profit margin, and more than most people think, but they don't have the ability to eat that. And so the stock price fell with about how much they thought this company's profits are going to fall. And if their profits are going to fall by 40, 50%, why wouldn't the stock fall by 40, 50%? That's about accurate. I mean, those ballpark numbers are actually quite good. So 3G Capital, right, said we're going to buy this company, and we're going to buy them at a price that is still at that $60 level, nowhere near the $78, $75 it's hit in the past. And they're saying, all right, if we buy them at the $63 level, what is priced in? What do they get out of Skechers by doing that? Well, U.S. GAAP accounting, as filed, the as-reported numbers would say Skechers has a much lower return on assets, a 6%, maybe a 7% return on assets in 2024, which is actually quite low. U.S. corporate average is 12 to 13%. Global corporate average is around 6 to 7%. So they're saying this is not a well-run business, not really well-run, Skechers, according to GAAP accounting. But when you look at uniform
just really
numbers,
quick. Well, before we get to uniform, to your point, Joel, right? And of course, to your point, if you're a 5% cost of capital business, when you have good, favorable sourcing and pricing, well, guess what happens when you get that barely cost of capital business hit with 145% tariff? No wonder, Joel, to your point, the market is basically saying, well, yeah, this is going to be a sub cost of capital business, maybe 0% ROA, not realizing, Joel, what real profitability is.
Not realizing that the company, now, one could argue that the tariffs, if implemented, and it hit Skechers at like 100% level or more, would really hit this company hard, right? All their sales are not in the U.S., so they wouldn't all be hit with it, but there'd be some blend that would knock this company's ROA down by 5 or 6 percentage points. Now, 5 or 6 percentage points, if the company's only getting a 6% return, says they get down to making no money, to zero. But if the company, in fact, is making something close to 12%, which is a U.S. corporate average, which is double the rest of the world's corporate average of profitability, of earning power, that return on assets, right, as that falls off to a lower level because of those things, it still could be making a profit. And so Wall Street was saying, hey, your returns are going to fall off. The market's expecting returns to go all the way down to like 5%, right? And you're saying, but what's priced in at $63? At $60 a share, it says the ROA holds at that level, right, of 6%. Well, if tariffs with China and U.S. come down to something more reasonable, like, I don't know, 20, 30%, if they're able to adjust their supply chain, if 3G Capital does what they prove, which is they got some really smart people inside that can make this company leaner and more efficient. They did it with Burger King. They've done it with others. They're not like buying the company only to flip it 2 or 3 years later. They tend to be a little bit more long and hold private equity buyers. $63 a share seems like a song. I mean, this is a big bargain to 3G Capital. I mean, kudos to them for swooping in and getting this company as cheap a price as they are.
Yeah, to your point, I mean, right, we already saw the whole entire idea of 145% tariffs basically put on pause, right? And now we're down to 30% after the announcement that the deal was struck with, in Switzerland. But the market was effectively pricing in, to your point, Joel, hey, this company is going to basically get trashed by this and never going to be able to fix it. Well, even if tariffs ended up after 90 days going back to 145%, which I think we all suspect that won't happen, but if they did, 3G already is very good at this operational stuff, right? For those of you who've ever heard of 3G, they, with Buffett, went in and basically bought Kraft Heinz, built Kraft Heinz. They're focused with the idea of zero-based budgeting of basically starting at zero every year and justifying all your costs. They're going to find costs to suck out of this business. They're going to be able to, because they are skilled at turning these consumer business around, be able to find cost synergies for the business. And Skechers probably isn't going to get hit by tariffs as hard as the market was thinking they are as the tariff regime gets resolved. All that says, everybody, to Joel, to your point, literally 3G is getting a steal here. And it was a really, really smart bet on their part in terms of being able to do it. And so we look at this and we say, hey, look, that makes a ton of sense for 3G to be able to take advantage of the situation here. And so everybody, right, we started the conversation by talking about GDP and how tariffs are making a lot of noise for GDP that makes it unimaginable and impossible for you to understand what's going on. And we wrapped up with talking about how tariffs are giving a really smart investor an opportunity to steal a company under people's nose. You never know how we're going to get from A to Z, but that's what the Altimetry Authority show is. Thanks so much, everybody, and talk to you in a few weeks.
Thank you, everyone.
All right, thanks everybody for tuning in. If you want to hear more and follow us on a daily basis, just click the first link below and be able to track what we're doing every single day.